what I'm going to do today is do a repeat of what we did last in our last event, which is a state of the venture market presentation. But essentially, where essentially what we do is throw together a bunch of slides which are interesting, which provides some light into, I would say, near-term data of the phenomena that we're all going through. But it's also nicknamed the deck, which is pretty depressing to read because it shows, it shows the markets we're in. But I thought after all that inspiration and after all that great kind of, call to action, it beckons upon me to kind of throw you with some reality check. So, I just wanted to start with when you're a founder, right? And when you think about capital raising and going through your stages, how is this entire kind of value chain of capital, how does it look like? Essentially, this is how VCs have been investing and founders have been taking in money. And over kind of various rounds, you've seen this chain, this funding chain kind of go through. So if you were a median kind of company raising from seed to Series D, you'd be raising 100 million, give or take. Obviously, this also depends on which industry you're in. Obviously, if you're in the kind of new age industry, in the Gen AI kind of systems, you're also raising much less because you need less capital to do so. But if you're raising capital for an e-mobility business and a climate business which needs a lot more capital, you'll be probably raising quite a bit more. So, that's the context we're all operating in. There are different venture funds who think about where to play, and we'll talk about that in a bit. But as a founder, these are some of the things which have been happening over time. But what's also been happening is the time taken for most of these rounds, which have started to kind of rise up. So if you were a seed to Series A company, the time taken for you over the couple of years has kind of really doubled. It now takes 2 years to raise Series A. It takes a further 2 years to raise Series B, another 2.5 years to raise, get to Series C. So it's the kind of time horizon is also longer, and you've gone into this phenomena of where there's no kind of rapid back-to-back fundraising, which usually happens. So that's the kind of context we're operating in. The other interesting thing that we've noticed is down rounds. Where we're in a world where a flat round is the new up round, and the kind of rate of down rounds is kind of sticky. It's about 20%. So it's normal because and that's a function of where markets were in 2021. And so you're starting to see a very distinct pattern emerge of down rounds happening. So how do we think about what pricing looks like in this market when a fifth of them are lower than what you expected? So another phenomena which we started to see, which is good, is burn rates coming down. So this is the median change of burn for VC-backed companies after 1 year after their kind of VC round, and you'll start to see the kind of curve fall, which is essentially companies are getting a lot more efficient, or maybe they've been forced to, and the burn is stagnating as these companies are kind of growing into their burn rates, which is a very, very different phenomena early on when you look at Series A, Series B, Series C. So again, I think the message around here is, you're taking longer, you are probably getting a lot more efficient, and probably the ask that you have on the market is probably falling, and so you need to be a bit more aware of that reality. So if you're a founder, what are some of the implications when you think about the cash runway required? And this is some of the data which is there from last year, is as an early stage entrepreneur, you need to kind of really plan more time for a transaction. You're not going to see rapid up rounds. You're not going to see you hitting the market quicker than you used to. You may have some pricing power, interestingly. I spoke about that slide where you had 20% down rounds. That's sticky. It's not going up. So it's staying flat there. So you have some pricing power as you're starting to raise Bs, but again, think more about that. If you're a late-stage entrepreneur, and we say this a lot, and you've probably heard this from your VCs quite a bit, is focus on your profitability. I think the vanity metrics certainly have kind of gone out of fashion. And you may kind of, VCs are okay to take risks on delay to IPO, but not on burn. And that's a consistent message we're seeing, but also kind of talking more about. So how has all this kind of affected the entire funding ecosystem? And by funding ecosystem, I mean fund managers, right? And one way to think about that is this really interesting chart that we love to see every quarter. This is the JP Morgan Guide to Alternatives. This is important because you need to contextualize where venture capital actually sits. And what you'll start to notice is from 2014 onwards, you've seen venture capital return annualized rates at the top, but then suddenly fall, stay up, and then kind of really fall back again. So it's going quite inconsistently, and it was quite compelling for a long period of time, but it is readjusting to a new norm. So that's where we sit within the asset allocation framework, if you may, of any large allocator. And that's a very important point to think about. You saw in Fosa's slides where the amount of funding to VC compared to other asset classes is much smaller. This is kind of there to contextualize that. You've also started to see some of the advantage over other assets erode. This is a very popular chart that most VC funds or fund of funds like to show to their LPs. Basically, they're trying to argue that global venture capital, or venture capital in general, has a very large dispersion. You take risk, and you can really outshine other asset classes like private equity, hedge funds, et cetera. This was back in 2012 to 2022. Move a few years later, that has narrowed quite a bit. We're now underperforming private equity. We're in negative territory. Suddenly, boring looks much better. And we're not kind of hitting things out of the park. So we're not the enfant terrible of the global asset allocation class. So again, something to think about as we're planning to raise. But another interesting phenomena has happened, which is it's getting kind of increasingly stratified. There's a lot of inequality in the venture space. You're starting to see small funds kind of really struggle, and a lot of the dollars go to some of the largest funds globally. So the bottom 90% of venture firms has raised as much capital as the top 2%. And you start to see this, as you see this chart, that a lot of the funding has been cornered, or there's a large concentration for large funds. What's happening with that is larger funds are deploying more per transaction and paying more for particular companies. So there's, again, massive concentration happening in companies as well. That is leading to a very interesting phenomena where fewer funds are also surviving. A lot of you in the room love cohorts. And so this is an interesting cohort of venture manager survival rates. What you'll see is somewhere around the 2009 period, the funds that were raised during the GFC had the lowest survival rates. What we're probably seeing is funds raised in 2019 have yet to raise a subsequent fund. So you're starting to see some issue come up in funds surviving as well. So I mentioned larger funds are getting larger, smaller funds are getting not well funded, and it's getting harder for them to raise subsequent capital. It's also leading to an interesting phenomenon of differentiated risk return profiles. What I mean by that is underperformance, where some of the larger funds are not as great as you think on returns as some of the smaller funds, which is a good kind of statistic to talk about when you talk about emerging managers, when you talk about kind of smaller funds out there. But again, just to be clear, there is a very, very distinct stratification happening within the venture market, which it wasn't there. So the whole cottage industry of the VC world is getting into a place where you have asset managers essentially looking at seed transactions. The persistence rate is also looking quite a bit steeper. This is essentially where you have a first-time fund kind of, it may be in the top quartile in the first year, but it starts to drop significantly. So the persistence of venture returns is also falling off. Less than half of the VC funds that ranked within the top quartile remain in the top quartile. So that fall off is also much larger, which again goes back to the fact why fundraising is a bit difficult. And it also is a very, very long time till when, as a fund manager, you start to see your entire kind of performance emerge. So if you're an LP, you got to wait 7 years to see where your TVPI ends up. That's when it starts to get sticky, and that's where you ultimately start to see some kind of a picture emerge. We know this, that the venture market is largely driven by unicorns. I think about 2/3 of the market value of all VC companies now are constituted by unicorns, billion-dollar businesses, 40% of whom have been held for at least 9 years, and that number is rising from your first VC round to a VC unicorn exit. So yeah, quite a bit kind of taking a lot longer. So the question that we all need to also ask ourselves is a 10-year fund even realistic? You'll start to see, there's a very interesting chart that I pulled out where it talks about median distributions, unrealized returns for top quartile funds. And you'll start to see that an 8 to 10-year fund cycle is not realistic at all. Most of the fund is not distributed. So while it says 10 years on the tin, it really is a 15-year product. And again, there are a lot of strategies that fund managers are thinking about, whether it's in terms of continuation funds, early liquidity options, extensions, et cetera. And these are decisions that come to LPs on what to do and how to think about these extensions. So again, something to think about. So as a fund manager, is there really something that we need to rethink a bit? There are alternative forms of liquidity that we're seeing in the market. There's a lot about fund sizing. There's a lot about strategy. I spoke about some funds becoming much larger. Is there something to think about where small is beautiful? And there's a lot of focus on portfolio math. And this is something we talk a lot to our GPs about. And I think some of them do a great job of thinking about how do you reserve capital, how do you follow on to winners, et cetera, but to at least have some kind of guide. Liquidity is an interesting kind of concept here around funds, and you start, this is a very interesting thing about secondary pricing. You can actually sell your LP stakes either by GP-led secondaries or bespoke portfolios. And the thing to understand here is that there is either a premium to your NAV or a discount. And over time, we're starting to see there was this huge period where venture portfolios were essentially discounted heavily, but that's kind of coming back. And we're starting to see a lot more secondary transactions take place to essentially ensure that there is liquidity. I spoke about the 15-year fund. You can actually crunch it down to much, much smaller. So that's an interesting bit. In terms of strategy, specialization is something we talk about. Does it matter? Here's some stats about specialists who, at the top quartile, kind of really, really perform much better than a generalist. And this is a very interesting aspect. When you think about the bottom quartile, you're more likely to lose money if you don't allocate well or if you don't have access in a generalist fund. By generalist, I mean somebody who's just does everything, there's no central thesis around it, versus specialists. I think what we see in our markets, whether it's in Africa, South Asia, India, Pakistan, Bangladesh, is there is a layer in between the generalists and the specialists, which is mostly the thematic funds. These are funds who invest across 2 to 3 sectors. They're not spray and pray, but they know what sectors to go at. I would suspect their performance is also somewhere in the middle of the generalist and specialist. Obviously, in terms of if you're a specialist fund, there's a higher conviction, things can go wrong, but there's a very different style in which you invest, and performance over time has kind of shown that. And after strategy, the most important point is fund sizing. And this is some data that we had from a while back, where you're starting to see smaller funds are generally outperforming larger funds. Clearly, the math works. You don't have to invest a lot and really chase after unicorns. But there's a very, very strong phenomena here. There's also an adverse selection for larger funds where it's driven by other motives. It's driven by management fees. It's driven by the need of LPs to invest in that. So there's this weird dynamic which happens, which pushes fund sizes larger. But again, you have to really think about, in this current environment that we're in, to focus on what your fund size is, what your fund market fit, founder market fit, GP market fit is all about. So a lot to think about fund sizing. There's a bonus reason to have a small fund, a smaller fund than usual. And so I'll let you in on a secret. The smaller the fund, the fewer LPs you have to manage. Yes. So imagine if you're a large fund, you'd have the median is 75 LPs. So that's 75, 74 more LPs more than us. So you don't want more of us to be in your fund. So smaller it is, the better it is for you to do that. I don't know if other LPs would host such lovely events for you, but it starts to get a bit annoying. So sympathies. So yeah, keep it smaller. You'll have fewer of us chasing you. But the one thing I wanted to kind of leave behind is to talk about portfolio math. But before we talk about portfolio math, this is time for some poetry. So bear with me. It's a very interesting poem. It says, "The night is gathering gloomingly, the day is closing fast. The tempest flaps his raven wing in loud and angry blast. The thunderclouds are driving athwart the lurid sky. But put your trust in God, my boys, and keep your powder dry." This was a quote by Oliver Cromwell at the Battle of Edgehill, 1642. It's part of a poem. That's the first time ever that dry powder actually appeared as in literature. So obviously, after all that while, I wanted to kind of challenge that concept, and so obviously having a British quote is pretty apt. But is dry powder really necessary? I think this is something we should all think really hard about. Do we have to rethink our reserve strategies? So there's a lot of kind of questioning of the conventional wisdom around reserve ratios that's happening right now, where if you just keep investing pro rata, what are the rates that you'll get? Because remember, as these companies raise higher, you're paying a lot more to keep that. And the challenge really is about how do you maintain the same returns to do that. So, do you invest in your winners right up front? Do you have conviction investing? Do you not keep any reserves at all? That's a question that's been asked quite a bit. This is a very heavy slide, so I'll obviously circulate this later, but there's, again, extensive research, extensive talks by Sapphire Ventures. It's a really large fund of fund that is thinking about, look, you can have a scenario where you concentrate everything into your winners, you spread the wealth, or you miss the big one. So if you reserve badly, where do you kind of end up? And it starts to get really interesting around this whole portfolio math aspect of it. So really think hard about that, because the results are actually quite striking. The top performing funds don't necessarily have high reserves. And so you'll see this interesting chart where upper quartile funds, the kind of percentage rates of follow-on are less. Because there's also this whole risk around if you reserve a lot and you spread it or you invest in the wrong company. It has happened quite many times that we fail to admit. you might actually be doing a disservice. So again, lots to kind of think about. But again, at the end, just wanted to leave everyone behind that this fundamental thing hasn't changed, which is what we think about the VC's virtuous flywheel cycle. You generate the strongest returns, you develop the strongest reputation, you do that, you attract the best entrepreneurs, you get access to the best deal flow, and that entire virtuous cycle keeps going on. That still remains in this market. And I think when you think about focused fund, right sizing, focusing on your strategy, reserves, et cetera, you will be kind of doing that in a much accelerated way. So that mantra hasn't changed. But yeah, so I just wanted to end this slide by saying, don't worry, that was depressing. But so I hope all thoughtful as well. So keep calm and carry on. But what we've done is, if you log on to the app now, you'll see a lot of questions posed to you as to what do you think you should be thinking about more, what's topical around fund managers as well as founders as they think about fund size and as they think about capital raising. So please do feed in, and we'll take that back. But thank you. And I think we have quite a bit of interesting sessions after.